Welcome to the Financial Compass e-learning series. This session will cover how to use the allowance for loan loss modeling features in Financial Compass. Using loan loss modeling in Compass provides two major benefits. First, the modeling establishes a link between the allowance account on the balance sheet and the provision account in the income statement. This eliminates the need for separate entries in these two accounts and helps assure that changes are reflected in both, and you can work from either account. Also, when a model is active, any change in loan volume will result in an automatic adjustment to the allowance and provision. This eliminates a common oversight of failing to increase the allowance as you increase loan growth. Second, different loan loss models can be created and saved for future use. This allows you to develop a model at budgeting time to streamline the projection process, but deactivate it once the budget is approved so that monthly updates do not result in any changes to the allowance or provision forecast amounts because of monthly changes in loan volume. Regulations require a quarterly analysis of the adequacy of the allowance for loan loss. If that analysis should indicate a need for adjustment, you can easily develop and save a revised model, apply it, then turn it off until a later review indicates another change in the future. Different scenarios can also be developed for credit quality or capital stress testing. There's no limit on the number of scenarios you can develop, and there is no need to start from scratch. Just modify an existing scenario and use the Save As function. Changes to the allowance for loan loss balance sheet account are usually driven primarily by the monthly provision for loan loss in the income statement. However, the provision amount is actually driven by at least two other factors: projected total loan levels and projected net loan charge-offs. That includes recoveries. Other factors may also be important for certain banks. Now, technically, this process is quite complex. Regulations require that banks consider many factors in the quarterly analysis to determine the adequacy of the allowance, but this analysis does provide an allowance level that you can convert to a required percentage of total loans at any current time. The detailed analysis includes evaluation of expected charge-offs and recoveries. This can be input directly into the Compass loan loss model, and then the information can be supplemented by other factors that we'll mention later. But now let's take a look at how the Compass loan loss model actually works. As we said earlier, you can access the model in the projections area of Compass from either the allowance account or the provision account. Once you activate one of these accounts, you will see a button under the EOM balance column. It will usually be labeled Manual unless allowance modeling has already been set up for your bank. Once you enable a model, the button will be labeled Modeled. When you click the Manual button, Compass will display the Allowance for Loan Loss model screen. Once that screen is up, click on the New Model to display the details of the model components. You can scroll up to see the monthly history stored in your Compass database, and you can scroll down to see the monthly projection through as much as 5 calendar years. Notice how the columns include elements we listed earlier as components of the allowance projection process. There's a date column, total loans, target allowance percentage, allowance for loan loss, net charge-offs, calculated provision, adjusted provision, resulting loan loss divided by total loans, and that's it. Let's see how easy it can be to project these loan loss factors through the next 5 years. First, obtain senior management's goals for the appropriate loan loss allowance level expressed as a percentage of total loans over the next 5 years. Now again, the quarterly analysis of loan loss adequacy should provide current levels, but the scope of that analysis might not extend for the full 5 years of the projections are included in the Financial Compass database. So if the bank has an annual capital plan or long-term forecast, future loan loss percentages could come from there. In any event, PlanSmith recommends that senior management discusses longer-term allowance needs at least annually, and they document these factors and the conclusions of that discussion, then incorporate them in this model. Compass allows the target allowance to be different for each month, although normally this is a target that will not change all that frequently. And also, it may be appropriate to establish a target percentage to be achieved over a period of time rather than immediately. The quick edits available in Compass allow easy input in those situations. First, let's say that management wants the allowance to be 1.8% of total loans at all time. Just highlight all of the projected months in the target allowance percentage column by clicking on the first column of the month, holding down the left mouse button, and dragging down the entire column. Once that's done, right-click anywhere in that area and choose Quick Edit from the pop-up menu. The Quick Edit default method is constant, and that's the one we want. When we enter 1.8 in the box to the right of constant and click OK, the 1.8% target is posted to every month in the highlighted range. The model then calculates the amount of the allowance at 1.8% of total loans each month and posts that amount of increase in the resulting allowance each month as the calculated provision. Note that only increases between months are posted. If the calculated allowance declines, the calculated provision is zero, not a negative amount or the amount of the decline. This corresponds to the normal practice of allowing the allowance to exceed the target until management makes a specific documented decision to withdraw the excess amount from the allowance by doing a negative expense to the provision or a recovery. If you want to show that action, you can enter the amount of the withdrawal as a negative amount in the adjusted provision column for the month that's expected to happen. Also, notice that achieving the 1.8% level in just 1 month, when the allowance had been only 8.85% the preceding month, results in a very large expense in a single month. And that's followed by much lower amounts in the later months. A bit later, we'll look at an easy way to level this out to take the shock out of that transaction. We still need to consider amounts in the net charge-offs column, but let's look at techniques for entering other common loan loss allowance targets before we do that. Our second example is that management wants to have different allowance levels for the later years in the projection. For example, management feels that they want to increase the allowance to 2% of loans, but not until January 2017. To enter that, just highlight the rows in the target allowance percentage column, starting with January 2017 through the rest of that column. Right-click the highlighted area and select Quick Model, and then enter 2 in the box to the right of constant. Click OK, and 2% will appear in the highlighted months, but the earlier months will remain the same. Now, a third example of loan loss allowance change is that management commits to achieve a higher allowance level by a certain date in the future and wants to get there gradually. So again, we'll use the example of 2%, but this time will allow us until December 2016 to achieve that level. So highlight the months in the column starting with the last actual month, which is December 2013, through December 2016. Click in the highlighted area, choose Quick Edit, then select Ramp to Value. Enter 2 in the box to the right of Ramp 2. Click OK, and we're done. As you'll see, Compass gradually increased the allowance each month to reach the 2%. So now let's move to the next data entry column, net charge-offs. An important part of projecting allowance levels is the forecast of charge-offs and recovery. Often these projections may be very erratic, especially in the early months of projections where management has a good handle on specific loans that may be either charged off or perhaps specific recoveries of loans in process of collection. Therefore, it may be appropriate to enter specific dollar amounts for each month according to the aggregate of those estimates. In later years, amounts may be more constant and should be consistent with the analysis conducted as part of the quarterly allowance review. You can enter those by using Quick Edits. Any amounts entered in the net charge-offs column will be added to the calculated provision if there's a net charge-off, or subtracted if there is a net recovery. This may create even more volatility in the monthly provision, but we know that management often wants to reflect a more consistent expense pattern, especially during a single year. The Compass charge-off model makes it really easy to achieve this. Just click on Distribute Provision Evenly at the top center of the model box, and the Compass will calculate a constant monthly amount that will result in achieving the target allowance level at the end of each calendar year in your plan. In fact, it even works on fiscal year if your Compass is set up that way. Once you're satisfied with model components, you must save the model either using Save or Save As if you begin by editing a model created earlier. Otherwise, no changes will be retained. After saving, click OK, and Compass will make all the adjustments in both the allowance and the provision accounts. Now, the OK button will not work until you've saved the model. Most banks will not want to reforecast the allowance every month, so to avoid that, just set the allowance modeling back to manual after you've gone through the process. This will not change any of the numbers that you forecast, but it will stop Compass from revising results every month as you have small changes in loan balances. The model you used will be stored, and you can reapply it or modify it and reapply it at any time in the future. Now, the fact that different allowance models can be saved is a great feature to support capital or loan quality stress testing. And there's no limit on the number of allowance models that you can create, either by starting from scratch or modifying an existing model and using the Save As function to keep both the new and the old versions of the model. And when you copy a Compass plan, all of the associated allowance models are included in the copy that you make automatically. Now, before we conclude, though, just let me point out one important limitation that will impact a few of our client banks. Loan loss modeling is currently designed to work with a single allowance account and a single provision account. If your bank separates either of these accounts into subaccounts, the loan loss modeling will produce erroneous results and is not recommended. Well, that concludes our session on the allowance for loan loss modeling and Financial Compass. If you have questions about loan loss modeling, give us a call at 800-323-3281. Ask for Compass support, and one of our experts will quickly respond. Thanks for taking the time to review this and for being a PlanSmith client.